Okay, so we'll talk about a couple different things in this lecture. So what we're going to talk about in this video, uh, they're not on the lecture notes, okay? But there will be two problems on the second exam on what we're going to talk about right now, okay? So try to pay attention. So we're first going to talk about the Federal Reserve. Federal Reserve. So the securities markets, the stock market and the bond market, they pay close attention to what the Federal Reserve does, particularly on the decision on interest rates. So the Federal Reserve sets interest rates. Okay, so they determine what's called the Fed funds rate. Okay, this is I think precisely this is the rate at which banks lend to each other overnight. But for this course, we'll just say this is very similar to the risk-free rate. Okay, so for the purposes of this course, we'll just say the Federal Reserve sets the risk-free rate. Okay, and this decision is based on inflation, employment data, and other financial conditions. I'll just say in financial conditions. Okay, so for example, we'll talk about this in the article that we're gonna discuss after this. During COVID, or recessions, in general, the Federal Reserve will set a very low interest rate. Okay, lower rates. That is, during these time periods, the economy contracts, right? So businesses are not really active. Consumers are not willing to spend more because the economy is bad, right? So in order to stimulate the economy, the Federal Reserve lowers the interest rates. Okay, so as we talked about, and as I'll talk about again, if the RF changes, this is basically the baseline interest rate. This affects the RD, the yield on corporate bonds, the RE, return on equity, and if we talk about other things, the mortgage rates. Mortgage, is that how you spell mortgage? Mortgage rates, your interest rate on your credit cards, and so on. Okay, we talked about the risk premium, right? Risk premium. So based on the riskiness of the securities or the assets or the borrowers, there's always a risk premium on top of the risk-free rate. So if the Federal Reserve changes the risk-free rate, it affects all these rates. Okay, that's why a lower interest rate would stimulate the economy. It would make it easier for firms to borrow money, thus, encouraging borrowing. And with lower rates, consumers, people like you and me, can borrow at a cheaper rate. So we feel easier about borrowing money because the interest payments will be lower. Okay, so when things are bad, the Fed lowers the interest rate to stimulate the economy. Okay, but if inflation is high, let's say inflation is high, that is when the economy is on fire, there's a lot of demand for goods, people are willing to spend more, basically prices get out of control because people have a lot of money. Okay, and that's no good either, right? High inflation is not good. So when these things happen, the Fed the Federal Reserve, the Fed, will lower or increase the interest rate. Okay, so I'll just say higher rates. Okay, and this is an attempt to cool down the economy. Economy. Okay. Yeah. So they do that. Okay. But what we're interested in is how the decision on interest rates affects security prices. Okay. So we'll do this down here. Just say day 0 and day 1. So these interest rate decisions are released to the public within like 1 day. Okay. So to be really precise, the markets react to the expected interest rate in the future. That is, if the rate hike or the rate cut is already expected in the market, those things are already priced in, so it shouldn't move the security prices. Okay, but we'll keep it simple and we'll just say, we'll remove the expected part of this relationship. We'll just say, if interest rate goes up, what should happen? If interest rate goes down, what should happen? Okay, we're keeping it simple. Okay, day 0, day 1. So let's just say the Fed, the current Fed funds rate, or we'll just say the risk-free rate, the current risk-free rate is 2%. Okay, and the Fed, for whatever reason, it could be that the inflation is high. Currently, if you pay attention to the world, the world is worried about inflation. Okay, that's because of the recent events. The U.S.-Iran war caused the Hormuz Strait to close, right? So it blocked the flow of oil to basically many parts of the world. And since oil is needed for everything, a shortage of oil will increase the prices of everything. Okay, so recently gas prices went up across the globe, and price levels generally increased. Okay, so inflation is a very important issue right now, and the European Central Bank, basically the Federal Reserve of the European Union, increased interest rates recently. Okay, anyway, so let's say from day 0 to day 1, the Fed decides to increase the interest rate. So we want to know what happens to the price or the prices of various securities. Okay, so this will be on the exam. So we'll just say, we'll have another column here just to make it clear. The risk level for this security, it's a risk-free security, so we'll just say the risk level is 0. Okay, and since we talked about bonds and we'll be talking about stocks, we'll have the RD, which represents the return on debt or the yield to maturity. We'll have another one here, RE, the return on equity. Okay, for the risk levels, we'll say the risk level for bonds are 2. I'm just making these levels up. And for stocks, it's 5. Okay, equity. So you'll see in the next video that equity is more risky compared to bonds, and I'll talk about why. Okay, but debt is safer than equity from the investor's perspective. Okay, but we already talked about this part. We'll say RD is 4%, meaning there's a 2% risk premium on bonds. Okay, so we talked about this when we mentioned the issuer risk and the maturity premium risk, right? So for any I'll quickly repeat it here. For any risky security I, the return can be characterized as the risk-free rate of return plus the risk premium. we can further decompose this risk premium. For example, in bonds, to issuer risk, who's borrowing money, and maturity. We'll just say maturity risk. Okay, how long they're borrowing for. We talked about this in bonds, right? So the basic framework is return on any risky security is the baseline rate of return on risk-free rate. That's the risk-free rate plus the risk premium. We'll just say here the risk premium is 2%. Okay, and we know that equity is more risky compared to bonds. We'll just say equity holders demand an additional risk premium of 3%. So the total risk premium for equity holders is 5%. 5%. Okay. I don't want to make it too messy, but yeah. So the return on equity would then be 7% on day 0. So this is prior to the Fed's decision on interest rates. Let's say they hold a meeting during this time and it's day 1, okay, the next day. So the Fed decides to increase the interest rate, the Fed funds rate, to 3%. So the risk-free rate, the baseline rate of return, is now 3%. First, let's talk about what should happen to the return on debt and return on equity. Okay. So what do you think? Think about it, but I'll tell you, the RD should also go up. So it can't remain the same at 4% because the baseline rate of return, the risk-free rate, went up. Okay. Now it went from 2% to 3%, and there should still be a risk premium. That is, even though the baseline rate of return increased, but the risk difference between the two securities did not change. RF is still the rate of return for a risk-free security, and RD is still this much more risky compared to the risk-free security. Okay, so investors will still demand their risk premium, and we're just going to assume that this 2% risk premium remains the same. So now the new RD becomes 5%, and same thing for equity holders. They're saying, oh, if the risk-free rate went up, then we will demand even a greater rate of return because the risk difference between these securities still remain the same. 5-level difference, right? So we'll just say this is 8%. Okay. So that's basically it. But if we go a step further, we know security prices change as the R's change. Okay, so now if we go back to the timeline stuff, we had a slide where how does the yield to maturity affect the bond price, right? That is, from day 0 to day 1, the deal did not change at all. Let's talk about a bond here, coupon paying bond. Oh, sorry, not infinity. We're talking about bonds. Let's say it was a 20-year bond, okay? And and the RD on day 1 was, using these numbers, 4%. Now it becomes 5% on day 1. So the timeline basically remains the same. 1 day has passed, but since we're working in years, that's very minimal, right? So if everything remains the same, but the RD goes up, that means all of these cash flows, when we're talking about price, all of these cash flows are being discounted, at a greater rate, greater discount, right? So whatever P was on day 0, maybe it was $1,000 on day 0. On day 1, if the RD increases as a result of the Fed funds rate increasing, P should come down. Okay, I didn't do the precise calculation, but it should be lower than the $1,000 because all else equal, the deal remains the same, all the timelines remain the same. The only thing that changed was RD went up in the market. Okay, so the market price of the existing bond should come down. Okay, so here the bond price should decrease. Okay, and same thing for equity. Okay, so we're going to talk about equity soon, but their projected cash flows are similar too. It basically remain the same. We'll just say $50 perpetuity. Okay, if RE used to be 7% on day 0 and it becomes 8% on day 1, basically the projected cash flows remain the same, the timelines remain the same. The only thing is, like, we zoom in and 1 day has passed. Okay, that is a minimal impact, right? So the price of the securities should change. It should go down. Okay, yeah, so equity price, stock price should also come down. Okay, hopefully this makes sense. Okay, so this is the key. You want to know this for the exam. It'll be a word problem. I'll give you a situation. I'll be like, the Federal Reserve either increase the interest rate or decrease the interest rate. What should happen to the RD? What should happen to the RE? Return on debt, return on equity, cost of debt, cost of equity. You'll talk about, and you'll see these terms in the next lecture. Okay, and what should happen to the prices? What should happen to the prices? Okay, that's the first part. Okay, let's move on. Okay, so next we're going to discuss an article. Okay, so it's on e-learning. It's called "It's a Good Time to Buy Bonds. Just Know What You're Getting Into." So this is a Wall Street Journal article written back in 2023. Okay, how do I? Yeah, right here. 2023 October. Okay. So yeah, you don't have to know the entire article. Just know what I'm gonna discuss. But it's a good article. It's not even that long, so you should take a look. Like 2 pages, and it talks about the bonds in general, shorter term, longer term bonds, what are bonds, and so on. It's a good review. Okay, but here is what I'm interested in. Okay, so after looking at the second paragraph here, after bond returns, okay, I get it. After bond returns hovered near 0 for years, a series of interest rate increases by the Federal Reserve has spurred a great return of yield in the bond market, okay, be it corporate or government or any other issuer. The 10-year U.S. government bond or the Treasury is yielding a high of 4.5%. Okay, so here's the situation. Yeah, so let's take a look. What happened was, because of COVID, the economy slowed down quite a bit. Everything froze during COVID, right? If you remember. That's why here's if you look at the site, we have the U.S. Fed funds interest rate. Okay, if you look at this blue title, I don't know if I can highlight this part right here. United States Fed funds interest rate, right? And here's a chart that shows how it changed over the past 10 years. So you can see right here, it used to be around like 2.5%, 1.75, but then after COVID hit, everything just stopped. The economy stopped. So in order to try to stimulate the economy, as we just talked about, the Fed lowered the interest rate down to almost zero. Okay, it's only 0.25% at this in 2020 and up to 2021, right? But what happened was, because of this, a lot of money was basically flooding in the markets, okay? And it drove the prices up, okay? So if you recall, inflation started getting out of control, okay? So the Fed changed their policy and started raising interest rates. You see a steep change in interest rates as soon as the inflation became worrisome, okay? So you see that when the article was written, that is October of 2023, if you go back, October of 2003, the Fed funds rate hit its recent peak at 5.5%, okay? So this is when the article was written, okay? So that's the background information. Again, to briefly summarize, because of COVID, economy basically stopped, and that's why the Federal Reserve cut the interest rates down to 0.25%. But because of this, people were borrowing and spending a lot of money, and it drove the prices higher and higher, and inflation now became worrisome for the policymakers. So the Federal Reserve started hiking interest rates in order to cool down the prices. Okay, so that's what it is. Okay, so that explains this part. A series of interest rate increases by the Fed, blah blah blah. Okay, and the 10-year U.S. Treasury bond was yielding 4.5%. Here, next highlight. So this means buying a bond and then selling it has been a bad investment for almost 3 years now. Okay, we'll pay attention to this sentence and the next sentence. Buying a bond and holding it until maturity, however, is what's now making money. So these two sentences we're going to focus on, and you should know what happened during this time period for the exam. Okay, and so these two sentences we're going to focus on, and we're going to explain using the concepts that we learned: the current yield and the yield to maturity. Okay. Okay. So this is the article. It's a good time to buy bonds. Time to buy bonds. Okay. So we're talking about two sentences here. Buying a bond, and the time period is very important. October of 2023. Okay. Buying a bond and selling it has been a bad investment for 3 years. A bad investment for past 3 years. Okay, so think about what this strategy entails. Okay, so you're gonna buy a bond and then sell it. So from the wording, it's not clear what they're doing precisely, but we know that they're not holding it until maturity, these bondholders, meaning these are short-term bond investors. Okay, and then the next sentence says, buying a bond and holding it until maturity is now what's making money. Buying a bond and holding it until maturity. Holding it until maturity is what's now making money. Now here is October 2023, right? Okay. And this strategy, buying it and holding it until maturity, is obviously a long-term bond investor. So if you reviewed the bonds chapter already, you should immediately know this deals with the current yield. There was a slide in bonds where we talked about various rates in bonds, right? And the current yield is the rate of return for precisely the short-term bond holders, whereas the yield to maturity, let's just say YTM, yield to maturity is the rate of return for long-term bond holders if you hold it until maturity. That was the definition of yield to maturity, right? So let's talk about this. We're gonna look at the graph, or I'm gonna draw a graph actually. So on the y-axis, we have return. On the x-axis, we have years. Okay, so we'll just say right now in this graph is October 2023. We're gonna mark it right here, right here. Right now is time 0. This is year 2023. Okay, so 1 year ago would have been 2022. 2 years ago would have been 2021, and 3 years ago would have been 2020, right? We're using real data, okay? And we're gonna plot the Fed funds rate, okay? So Fed funds rate we saw right here, it changed from 2023 was a 5.5, 2022 was about 3.25, and 0.25 in the previous years, okay? So we'll just call this the risk-free rate to make it simple, okay? So the risk-free rate went from about 0.25% from here, and then in 2022, 3.25% right here, and 5.5% when the article was written. Okay, this was the this would be the plot for the risk-free rate during this time period. Okay, I'll just say this is the RF. Okay, let me move this down slightly. You'll see why. And then I'll extend the y-axis slightly. Okay, so going back to the little discussion on return on risky securities, we said this relationship basically holds. Okay, for any risky security, their return can be characterized as the risk-free rate of return plus the additional rate of return that investors get for bearing that riskiness of the security. Okay, risk premium. Okay, we said bonds. I'll use the green line for bonds. So bondholders generally get a greater rate of return on top of the risk-free rate. Bonds are more risky, right? However, this is the risk premium on bonds. Okay, same thing for equity holders. Blue line here. Equity holders are they're exposed to more risk compared to bonds. So RE is even greater than the RD. Okay, this will be the risk premium on equity. Okay, so what I'm trying to show you is what I discussed in the previous part of the video, that as the Fed funds rate goes up, I don't want to use too many colors. I already did. Yeah, I don't know. Yeah, as the risk-free rate went up from here to here, right? It went up this much in from this year to this year, right? Risk-free rate went up by like 3%. That should mean that the return on bonds should also go up by approximately that much, and return on equity should also go up. Okay, so yeah, that's why all these rates of returns are moving in the same direction, because the baseline rate of return goes up. Okay, yeah. So yeah, let's talk about this statement and this statement. Okay, first statement, we'll talk about the current yield. Okay, current yield. So let's say we have a bond investor who purchased a bond in 2021. Sorry, let's say the bond investor purchased a bond in 2021, and they're a short-term bond investor. Their plan was to sell it after 1 year in 2022. We'll see what happened to their return. Okay, and we're gonna draw the timeline. Okay, so let's say they bought the bond in 2021, and this again is a short-term investor. Okay, so if we look at the timeline, we're just gonna make up these numbers. So let's suppose that they bought a 30-year bond back in 2021. So 2022, 2023, so on. And the coupon payments were $50. Remember, the coupon payments will never change. It's the deal, okay? And let's say they bought this bond at $1,000. So it was a par bond, okay? So the strategy of this bondholder, as a short-term investor, they only cared about this part of the timeline. Let's say their plan was to sell it after 1 year, okay? So in 2021, their expected return, okay, we'll just call this the plan in 2021 when they bought the bond, the expected return was this. So you want to follow the what their plan was. They bought it at $1,000, so they're gonna collect $50, which is pretty much guaranteed unless the firm goes bankrupt. So they were gonna collect the $50, and then they were gonna sell it in the market at whatever the price is in time 1. Okay, so we're gonna separate the capital gains component and the interest component, as we did in the current yield part of the lecture. So mathematically, we're just going to denote it like this. So the plan in 2021 was whatever the price is in time 1, they were going to sell it. So the return is this. That is P0, we already know. It's $1,000, right? So they were paying $1,000, and they were just gonna sell the bond in the market in time 1. Okay, but we don't know the price yet. Okay, but we know how much coupon payment they'll be getting, $1,000, How much is the coupon? We know that it's $50. Okay. So this part was a little confusing. The expected value of price 1 using all information in time 0 was $1,000. Okay, that is, in 2021, no one knows what the price in time 1 will be. Okay, so the best guess is still $1,000. Okay, that's market efficiency, and yeah, so the expected capital gains percentage was 0% back in 2021. That was the plan. But they were going to collect the $50, and this is the current yield component. So their expected return was 5%. That was the plan. Okay? But now time passed, and we're now in 2026, so we know what actually happened in the market. What actually happened was, as I just showed you, the RF went up because of high inflation, which in turn drove up the RD and the RE. Okay, so from here to here, what happened was, in the RD 2021, it was 3%, but in 2022 it became 5%. This is unfortunate for the short-term bondholder. Remember, I just showed you, if the RD increases during this time period, keeping the deal the same, because the deal doesn't change, if RD goes up, the current price comes down, right? So P1 was expected to be 1,000, but in reality it dropped. Okay, that's why it was unfortunate for these short-term bondholders. So we're going to say actual in 2022. Now in 2022, the actual return is, this part is no longer 0% because we now know what the price is. We'll just say the price dropped by $100. So the actual bond price in time 1, this is P1, was $900, but the bondholder already paid $1,000 in time 0, right? So the capital gains component, if you look at it, this thing is negative 10%. But fortunately, they still collect the $50 coupon. You know, that deal was already set. So they made about 5% return here. But the net return was negative 5%. Okay, this is the actual return in 2022. I hope you were following this. Yeah. So again, to summarize, this illustrates why this article says buying a bond and selling it has been a bad investment for the 3 years. Okay, that is, for short-term bondholders, they have been losing money. Okay, but if you really understand what's going on, when they entered the strategy in 2021, their strategy was not to lose money. Obviously, they wanted to make money. Okay, so their goal, if you really follow the logic here, their plan was to get an expected return of 5%, and they were going to exit the market. Okay, and this is because no one can guess what P1 is at time 0. Okay, if they could, they'd be incredibly rich, right? But things didn't go according to plan. The actual numbers changed based on what happened in the real world, and we saw that the RF went up, driving the RD up along with it. And if the RD goes up while the deal remains constant, we know that security prices come down. Okay, we just talked about it, right? So security prices came down. P1 actually dropped. It didn't stay the same. It didn't go up. It didn't work out for the bondholders. P1 went down. So the value of the bond just dropped by 10%, but they were still able to collect the coupon payment, offsetting the loss a little bit. Okay, but that's why bondholders lost money during these years. Okay, that was the first statement. Okay, a little bit. Yeah, people usually find this a little tricky, but I hope you're getting it. Okay, so bondholders, short-term bondholders lost money. Okay, second part is easy. Buying a bond and then holding it until maturity is now what's making money. Now what's now making money. Okay, so for this, we just have to look at the YTM. Okay, RD is basically the YTM, right? The yield to maturity. So in 2023, according to the article, buying a bond and holding it until maturity is what's now making money. Give them a green highlight here. In 2023, the RF was at the peak, right? And if you look at the graph, the real graph, it actually hit the peak and then dropped. Okay, it might go back up, but it dropped, right? So it worked out really well for people who entered the bonds market right here. Okay, at the peak was the highest RD. So remember the definition of the yield to maturity. Definition of yield to maturity. If you buy the bond and then hold it until maturity, you're guaranteed this yield, YTM, yield to maturity. Okay, so buying a bond right now, as in October 2023, and holding it locks in the rate of return, the high rate of return. Okay, that's why the second statement makes sense and the first statement makes sense. Okay, so try to understand what happened here, not just for this problem, but you'll do well in the bonds part if you understand how the current yield works, the difference between the current yield and the yield to maturity. And for the exam question, just know what happened in this article. Okay, it's a good time to buy bonds. Make sure you understand when the article was written and after COVID, and pay attention to these two statements, and then you'll probably get it right. Okay.